Today, we're going to be talking about underperformance in your investments. We're going to be comparing large cap growth and small cap value. So in other words, we're going to be looking at larger companies that are growing quickly versus smaller companies that are typically trading at a discount. And we're going to discuss what does underperformance look like in each of these asset classes and why it is incredibly important to understand the difference between these two. Because as you'll see when we get towards the end of this video and start to look at some of the numbers, it can be the difference between failure and success with your long-term income plan. Okay, so let's get started. And again, to review, what we're comparing here is large cap growth and small cap value. Now, why are we looking at these two? Because they're very different asset classes. So while we're still looking in the US, these larger companies like the S&P 500, right? These are companies that you know, these are big tech companies that many times can get pretty expensive because people are thinking, hey, the earnings are gonna grow, so we're willing to pay more for future dollars coming from these companies, so that's why it's considered growth. Versus value investing, or in particular what we're looking at here is small cap value or smaller companies typically not anticipating a ton of growth, at least in the way that we're buying those assets. So we're able to get essentially a deal on the future cash flows of those investments. Now, both two different styles. We're not going to talk about which one's better or worse. You can let the numbers help you come to that conclusion. But what I want to talk about is if you look back at history and you look back over the last several decades and you said, what is the worst 10-year performance I can expect from each of these asset classes? Now, again, no one knows anything about the future. However, let's look back at history as our guide to give us some context. So let's get started. This is looking at the two rolling 10-year returns for the S&P 500 and for small cap value. So large companies and smaller, less expensive companies. And rolling 10 years just means this gives us a good way to look at what are the worst 10-year returns that we can see in these investments. So this line is giving us the rolling, so what it's been over time. But down at the bottom, over in the right, where it says min, that means minimum. So what has been the worst case scenario over any 10-year period in S&P 500 and in small cap value. Now, as you can see, the minimum number, now you'll notice I'm not talking about the average or the maximum because talking about the most return you can get, well, if you're getting the most or you're even getting the average, it's probably not going to be detrimental to your long-term planning. I want to talk about worst case scenario. And in this situation, we have small cap value returning about 3.9%, and we have the S&P 500 returning about 3.4% negative, or losing a little more than 3% per year. Now, so what does that mean? What it means is if you were to invest at the worst possible time with small cap value, you would have gained about 3.9%. So that is nothing to write home about, but it's about 4%. It's not the end of the world versus the S&P. If you would have invested at the worst possible time period, your 10-year average rate of return would have been negative 3.43% on average per year. Okay, so that doesn't seem like a huge difference. Positive 3, negative 3. What does that mean in dollars terms? Because we don't grow or spend our money based on percentages. We spend real dollars. So what does that mean in real dollars? And so what I want to show you here is comparing what does the growth of your money look like starting with $1 million. Now you can use 10 million or 100,000, just add a zero or take one away. This just gives us a framework to work from. But if you started with $1 million, 10 years later, if you were to invest in the S&P 500, what does that mean? Versus 10 years later with small cap value. What would that mean? This is with no withdrawals. If you were to start with the S&P 500, losing about 3% a year, you'd start with $1 million and you'd end with about 700,000 at the end of that 10 years. So you waited a long time and you lost a decent amount of money, and that was between 99 and 2010. Many people call this the lost decade because you could have invested for a long time and essentially made no money. Now, how do we compare that to the worst scenario for small cap value? Well, this is 10 years later, so starting in 2010 to 2020. So pretty recent, your $1 million would have grown to a little under 1.5 million. Not averaging 10% or anything close, but if you compound about 4% for 10 years, you end up with a decent rate of return. And so as you can see, the S&P 500 from 99 to 2009 was down quite a bit. in its worst scenario, and small cap value, even in its worst scenario, still grew at a reasonable pace. So that is with no withdrawals taken out. All right. What I want to talk about now is what happens if you are drawing income from your portfolio. Now, we've discussed the 4% rule, or withdrawing 4% from your portfolio as a reasonable distribution rate to maintain over your retirement lifestyle. So let's look at the same charts, but add in $40,000 distribution. Okay, so here's the S&P 500. We started with $1 million in 1999, and we went 10 years to 2009 and have taken out $40,000 a year. And now we are at about $450,000. So essentially your money has been more than cut in half during that time period. Versus comparing that to small cap value, so those smaller companies during their worst time period from 2010 to 2020, your $1 million would still be worth a little over $1.1 million even after you taking $40,000 a year. And so while looking at this, small cap value is up 3.9, comparing that to S&P's, which is -3, it doesn't really discuss or show the significance of that difference in the context of your dollars. Because if you're taking out $40,000 a year or 4% from your portfolio and you own this small cap value, well, you have about what you started with or something close, even in its worst case scenario. Again, not talking about the future, but this is several decades worth of information. Versus in the S&P 500, you would have gotten your money cut in half, which is not the end of the world in that decade, but your next decade becomes quite a challenge, because if you are still taking out 4% or $40,000, right, from $1 million, and now you only have $500,000, that is almost a 10% distribution rate. And so the real issue becomes, if you have an asset class that has a very low rate of return over an extended period of time and you're taking out income, it can be catastrophic for your long-term plans. You think, okay, Kyle, what's the takeaway here other than being really scared of getting my money cut in half? The importance here is looking at these two timelines, these two time periods. And as you can see, with the S&P 500, when did it have its worst performance? From 1999 to 2009. Okay, well, what if we go to small cap value? When was its worst performance? Well, 2010 to 2020. So these were different decades. And what happens is, if you invested in them both, your performance was just fine, right? You did not have the issue of having a large underperformance over an extended period of time, because one zigs, the other zags. They're designed to move in different directions. And that is a long way of going about saying, for long-term investors, it is important to diversify, right? The S&P 500 is great, small cap value is great, international is great. These are all different asset classes that are designed to move differently from each other, which means, as a diversified investor, you're always going to wish you would have just been in the one that did the best. And over the last 10 years, that's been the S&P 500. It has looked great. But it's important to remember that there are time periods when that has not been the case, and there are time periods when it won't be the case again. And so look at your portfolio, make sure your eggs are not all in one basket, and you can diversify and have some peace of mind knowing that these longer term downtrends aren't going to be as impactful to your investments. I hope you found this helpful. And as always, thanks for investing your time with the Personal CFO.